Okay. All right, so let's go ahead and so today we're going to take a look at the second depreciation method. Okay, today we're now going to be looking at double declining. Okay, so once again, every depreciation method that we look at, we're going to be looking at the same 5 components, right? We need to start with the asset cost, all right? But this time, instead of the number of units that it could be produced, we're going to be looking at the estimated useful life, okay? And in this case, we are also using the salvage value or residual value. And most important is the date that you place in the service. This is the most important thing. And then last but not least, you need to know what depreciation method you're working with. So in this case, component number 5 is already given because we're focusing on double declining. Okay? So this time, right, when we look at double declining, this is where we are taking an aspect where it's a common depreciation method that is used with IRS. They widely use this type of one because it deals with technology. Okay. Now, when we use double declining or accelerated depreciation, right? The main idea here is that when we purchase assets, right? Depending on what kind of asset it is, right? Oftentimes when we buy a brand new piece of equipment or some kind of technology, right? You tend to use it more often in the beginning of its life, and then you tend to slowly use it less and less and less, okay? Like a great example is if I were to buy a laptop for school, right? I'm in school, so I'd be using it, a lot more frequently every day, in the beginning of its life. But as it slowly, go through the years, I don't use it as often because, I work now. I don't use the laptop as much, right? Because I have like the laptop that the school provides or something, whatever, right? You tend to not use that laptop anymore as it goes on through the years. But also second thing too is that technology, gets slower and slower as the years get passed, right? Because there's newer and better technology out there. So every time you buy some kind of some kind that has some kind of technology in it, you're gonna tend to use it less and less towards the end of its life because, again, it's not as fast anymore, right? If you try to open up a laptop that you bought 7 years ago, imagine how long it's going to take you to turn it on, right? So that's what I'm trying to say is that you tend to use it a lot more frequently in the beginning of the year or beginning of its life because it's a lot more quicker. It's something that you're just using so much, and then as it gets through its life, right, you tend to not use it as frequent, or you tend to the technology in it begins to become obsolete. Okay, so that's the reason why we use double declining. So here is the formulas that we use for double declining. Now it's a slight variations. Okay, so in this case, the depreciation basis, right? In this case, this is where it's asking that it's going to be the beginning of the year's book value, okay? So the day that you purchase it, right, is going to be the first year's book value, right? Because you haven't started depreciating it yet. So the book value of it is going to be the asset cost. But because every single year when we depreciate it, right, we solve for a book value or a book value. So it's kind of like when the first year, once you depreciate it, right, you end up getting a book value at the end of year 1. And of course, that means for year 2, the beginning of the year's book value for year 2 is going to be the end of year 1. So in this case, we're going to be using the book value for the depreciation basis. Okay? So therefore, every year you're going to be calculating a different value. Okay? And then, of course, the depreciation rate this time is going to be 1 over its estimated useful life times 2. Okay? 1 over the estimated useful life. So you're spreading the entire life into years, or in this case, 1 over whatever amount that life it has, and you're going to multiply by 2 because you are going to be depreciating it twice as much, hence the word double. Okay, so that's what that's right there. And then, of course, the depreciation expense is going to be the rate times the basis. Okay, and of course, the accumulated depreciation and book value, all of those are going to stay the same. Accumulated depreciation is going to be your previous accumulated depreciation plus your current year's depreciation expense. And then you're going to have your book value is going to be the cost of the asset minus the accumulated depreciation. Okay? So then, and then when book value comes at the end of the end of the year, this is also something that you have to keep note, that at the end of when it reaches near close to the end of its life, okay, you must be equal to salvage value. Now, if I'm depreciating it twice as much, there's a possibility that your asset can either go beyond its life or it actually gets shortened by a lot because you're depreciating it twice as much, okay? So let's go ahead and dive into our first example here. All right, so the first example here is when we bought a machine, okay? And its cost right now is $15,000. Salvage value is $2,500. Its estimated useful life is 5 years, okay? The number that it could produce is 10,000, and the date that you place into service is as of January 1st. So assuming that you depreciate at the end of the year, December 31st. So in this case, right, the date that you place it into service is very important. So in this case, since I placed it into service as of January 1st, that means I'm going to depreciate as of January. So January all the way to December is exactly 1 year. Okay? So in this case, all right. Let's figure the numbers out. So again, depreciation basis is going to be the beginning of the year's book value. In this case, I haven't depreciated my asset at all. What is my fair market value right now if I just purchased it and placed it into service as of January? So in this case, how much did it cost me? It cost me $15,000. Okay? So then, my depreciation rate is going to be 1 over its estimated useful life times 2. Okay? So in this case, you're going to do 1, like the number 1, and you're going to divide that amongst by 5 years. Okay? So if you do that, you're going to get 20%. Since you're going to multiply it by 2, it's going to become 40%. Okay? So in this case, 0.2 or 0.4 is the same thing as 40%. So in this case, 1 over 5 gives you 0.2 times 2 gives you 40%. Okay? So then, now, the depreciation expense is going to be the depreciation basis times the rate. So it's going to be 15,000 times 0.4 or 40%. And that's going to give you $6,000. So in this case, right, we're almost cutting this asset in half. Okay, because we're using it in the beginning of its life. Now, if this asset only had 5 years, then you could already tell you're going to be using it very frequently in the very beginning of its life. So there you go, 6,000. Again, accumulated depreciation is going to be previous years plus current year's depreciation expense. In this case, we are depreciating for the first time. So therefore, 6,000 is going to be there, right? 0 plus 6,000, gives you 6,000. So now this is the most important thing that we got to do is solve for the end of the year, for the first year. What is my book value here? So again, we're going to take a look at the asset cost of 15,000, and we're going to subtract my accumulated depreciation, which is 6,000. So that's going to leave me with $9,000. Okay? So this is where you're going to take this book value of $9,000 and you're going to pop it in, because that's going to be the beginning of the year for year 2. Okay? So then let's go and keep solving, right? What's the depreciation rate? It's still going to be 1/5 times 2. So in this case, it's going to be another 40%. And we're going to multiply 9,000 by the 40% to get me now 3,600. Okay? So we're taking another about half of 9,000. Well, in this case, it's 40%. So almost half of it. So in this case, right, as you can see, we're shrinking this asset half of its life every single time, right? And that's what double declining does, right? You're cutting its life essentially in half, in half, in half until you reach 0 or you reach your salvage value. So in this case, 3,600, right? 3,600 plus 9,000 gives you a total of 9,600. So then we subtract that out of 15,000, gives you now a remaining of 5,400. And then the rest goes on and on, okay? Until you reach your 4th year. Now, in this case, right, when I'm depreciating and depreciating and depreciating and I'm continuing on and on, you're going to be noticing something, right? Boom, on the 4th year of my asset's life, when I solved for it, look at my book value now. It has dropped 1,944. In this case, right, the rule that we have to govern is book value can never fall below salvage value. Okay? It can never be less than salvage value. So then in that case, there is something that I have to do. I cannot go beyond salvage value. So what I have to do is I must work backwards. It must be equal to salvage value. So I must work backwards to figure out how much do I have to depreciate in order to get to my salvage value. Okay? So if I know that is given, that my book value should equal salvage value, right? I'm going to actually be working backwards. Okay? So this is a lot of math that's going to be involved. Okay? So the formulas that you're going to be looking at is you're going to be working backwards. If I know what book value is, right? And I know what the formula is to solve for book value, the book value is going to be my asset cost minus accumulated depreciation. So in this case, I know what my asset cost is, and I know exactly what my book value is. So in this case, my book value is $2,500, and my asset cost is $15,000. So in this case, to solve for my accumulated depreciation, you're going to do reverse math here, or in this case, order of operations. So in this case, when you're trying to solve for the missing variable, you're gonna plug in the components into the formula, and you're going to rearrange it in a way that you solve for the accumulated depreciation. So in this case, if my asset cost is $15,000 and the end goal is I need to be at $2,500, right? I'm going to simply rearrange my formula to reflect that now to solve for my accumulated depreciation, it should be your asset cost minus your salvage value. And that's going to give you $12,500. right? 15,000 minus 2,500 is going to give you your accumulated depreciation, okay? So again, this is another formula. It's not nothing you don't have to memorize, because in this case, you're just rearranging and solving for the variables, because these formulas are nothing new. They're just rearrangements to solve for the actual one. So in this case, if you can't plug it in, then you can memorize it, that the accumulated depreciation is going to be the cost of the asset minus book value. Okay? So now you get 12,500. Now, again, we need to now work one more step backwards, because now we need to solve for how much the depreciation expense is going to be. Well, if I know at least this much, that my formula to solve for accumulated depreciation is equal to the previous year's accumulated depreciation plus the current year's depreciation expense, then I do the same exact thing. I'm going to plug in my numbers to solve for my missing variable. So in this case, I do know what my accumulated depreciation is. It's 12,500. And I do know what my previous accumulated depreciation is. It's going to be the 11,760. So in this case, I'm going to rearrange so that I can solve for my current year's depreciation expense. So in this case, pretty straightforward. You're going to take your accumulated depreciation, okay, for that current year, and you're going to subtract your previous year. Okay, so you're going to take your 12,500, subtract 11,760, and you're going to get your current year's depreciation expense. So in this case, my total number here is $740. So when I plug that in, then that is it. I cannot continue using this asset anymore because it's reached its end of its life. And look at this. It didn't even reach 5 years. Okay? So in this case, this is time sensitive, okay? But it's also depending on the very crucial point that at the end of its life, it has to reach salvage value, okay? So in this case, right, because we're using the asset so much in its beginning of its life, there are many reasons that it could not last its full 5 years because you're using it twice as much. Okay, so that's one factor. Or if you use it twice as much and you have your salvage value at 0, then you're going to continue going on and on and on and on until you reach 0. Or once you reach its end of its life and you have a little bit of money remaining, you could choose to dispose the asset right then and there. Okay, any questions about this one right here? So double declining. You got a few different components that you're dealing with, okay? Instead of dealing with the asset cost minus salvage value, you're dealing with the beginning of the year's book value, okay, for your depreciation basis. The rate, once again, is 1 over the estimated useful life, okay? And then at the end of its life, whether it reaches its life or not, you need to be very careful to make sure that the book value does not fall below salvage value. And if it does, that's where you have to stop there and you have to figure and work backwards. Okay, any questions here? No. Okay. So here's a few things that we're going to notice, right? It doesn't reach its end of its life, so it's less than 5 years. This is going to be your beginning of the year's book value. So again, solving for the book value from the very end here, you're going to carry those numbers over. The rate will always stay the same. So this is consistent, okay? And of course, your book value must end with the salvage value, okay? So how do we journalize this, okay? in this particular journal, it's going to be identical, right? That you're still going to have recognized depreciation expense, and you're still going to do your accumulated depreciation. However, the only difference here is your calculation, the number that you're going to be using. So in this case, right, when I solve for my depreciation expense for the very first time, for the first year, then I say here, boom, it is $6,000, okay? So once again, this is very similar to when we do inventory, right? No matter what, you're still going to have their cost of goods sold and stuff. It's just a matter of the calculation part is going to be different. The journal's all the same. It's just the calculation that's different, okay? Now, how do you know which depreciation method to use? That's going to be depending on what kind of asset you have, okay? So again, with this one depreciation method, it is clear. It is up to you what you want to do. It is the easiest one will be tomorrow, okay? But this one is another depreciation method that we learned today, which is double declining. Okay. All right. And then same thing with year 2. You just do the same thing. Depreciation expense, accumulated depreciation for the second year, which is $3,600. Okay. Now in this case, every year the depreciation journal entry will be different. Okay. So then I'm gonna introduce you to partial years. Partial years is going to be the most important thing because we are depending on the asset's life, right? In this case, right, we want to make sure that we count every year. So in this case, because we are looking at the estimated useful life when we calculate the rate, it is very important to know when we placed it into service. Okay, because this is now time sensitive. Okay, so in this case, right, I bought an asset. Okay, it's it's worth $10,000. That's what its cost is. And it has a salvage value of $2,500. Its estimated useful life is 5 years, and it can produce up to 25,000 units. And the date that you place it into service is going to be October 14. So in this case, right, when we talk about date that we placed into service, this is October 14. So what does that tell me? This tells me, right, is it more than 50% of October? Right? What's the rule? It falls between the 1st and the 15th. So therefore, it's the 14th. So that is 50%, more than 50% of October. So therefore, you're going to start depreciating as of October, November, and December, right? Assuming that the depreciation happens at the end of the year, okay? So in this case, right, that means my asset for the first year is going to be only 3 months old because I have October, November, and December. So how do I calculate this now? Okay, assuming that if you're doing based on January to December, right, I'm going to solve exactly how I should solve, right? So in this case, the depreciation rate, depreciation basis is going to be what you started out with. So what's the fair market value? In this case, it's $10,000, all right, which is the beginning of the year's book value. Depreciation rate is going to be 1/5 times 2. So once again, 1/5 is 0.2 times 2 is 40%. And then I just multiply across. So in this case, 40% of 10,000 is going to be 4,000. Now in this case, right, when I'm calculating this number here, this is for a whole year of its life, okay? So 4,000 is an span of 1 whole year of its life. Now, if you remember yesterday, we talked about this, right? How old is my asset right now? If I place it to service as of October 14, my asset is definitely not 1 year old. It is only 3 months old. So in this case, I cannot depreciate it for the full 4,000 because in this case, if I'm depreciating it 40% of its time, right? This is in a span over 1 year, right? That's hence why the rate is 1 over its estimated useful life. You're trying to spread it across its evenly through its life. In this case, this is when I calculate this amount, this is for 1 whole year of its life. So in this case, we need to calculate it to represent, well, hey, my asset's not 1 year old yet. It's only 3 months old. So in this case, I have to do some kind of way to figure out what kind of math is involved. So in this case, 3 months out of 12 is going to give me a quarter of a year. So right now, my asset is only a quarter of a year old. So what I'm going to do is I'm going to either take either or, whatever way that you feel the most comfortable using, is you can figure out that, okay, if I'm going to depreciate it, right? If I'm depreciating at the end of the year, then I know that I have October, November, and December. So that's equal to 3 months. There's 12 months in a year. Okay, so in this case, I had to do this in terms of years and convert the time in according to the year. So in this case, 3 out of 12 is a quarter of a year. So you can either use 0.25 or you could just go ahead and just multiply 3 and divide by 12 across. That's going to give you the same exact answer. Okay, so in the case of my depreciation expense, since it is $4,000, right, I'm going to either multiply that by 0.25, or I can multiply by 3, divide the whole thing by 12, and I will still get the same answer of $1,000. So this is the correct depreciation because my asset is only 3 months old. Okay, and boom. So therefore, the first year of depreciation, since my asset is only 3 months old, I have to treat it as its age. So in this case, I can only depreciate it up to $1,000. Okay. Oh, any questions there? This is called partial years. Okay. So once again, how do I journalize it? Same exact ordeal. You're going to have your depreciation expense and your accumulated depreciation for that $1,000. Okay. So course review, here is the formulas. Okay, so again, the formula for the double declining is right there. Okay, and if whatever book value falls below salvage value, these are the backward formulas that you must solve backwards for. Okay, so again, double declining is when you use it when you use the asset more frequently in the beginning of its life, more than towards the end of its life. All right, and then last thing we have here is book value must equal to salvage value. Okay, always. Okay. So let's go ahead and dive into the exercises. So let's see. Let's start with question number 1 through 3. Okay. And all right, let's get started. So here, okay, number 1, you purchased a cash register for $300, okay, with no salvage value. Its useful life is 5 years, and it can print up to 5,000 receipts, okay? And of course, you put this cash register into service as of January 8th, okay? So assuming you're going to depreciate at the end of the year, okay? So let's go ahead and plug in our information here. So what did we buy? We bought a cash register, right? How much is my cash register? $300. Okay? What was my salvage value?
5 years.
Salvage value.
It has none.
There's no salvage value. Okay? And then Maribel answered the useful life is 5 years. Okay? And in this case, we don't care about how many units it can produce because we're focusing on time in regards to this depreciation, right? And when did I place this asset into service?
January 8th.
January 8th. So what does that tell me?
A full year.
You're going to depreciate it for a full year, right? If I'm assuming that I do depreciation at the end of the year, December 31st, if I'm depreciating it as of January 8th, therefore I need to depreciate January all the way to December 31st. So that's exactly 12 months. So in this case, what is going to be my depreciation basis?
$300.
It's going to be 300, which is the beginning of the year's book value. Good. Okay. What is going to be my rate? Good, 40%, right? It's going to be 1 over its estimated useful life, which is 5 years, divided by, times 2, right? Multiply by 2, because it's twice as much. So 1 divided by 5. So that means 1 year out of its life, right? Times 2, which gives you 40%. Okay? So in this case, what is going to be my depreciation expense for year 1?
120.
Right, you're going to take your 300 times 40%. I forgot comma 2. Comma 2 is 120. Okay? So again, what is my accumulated depreciation for year 1? It's going to be your depreciation expense because there's no previous one. So then what is going to be the book value as of year 1? At the end of year 1?
180.
180, right? You're going to take your 300, okay? And you're going to subtract your 120, will give you 180, okay? So then what becomes your depreciation basis for year 2?
The 180.
The 180, right? The end of the year's book value as of year 1 is going to become the beginning of the year for year 2. Okay? So then, let's go ahead and solve for the next, let's continue. So what's the rate here going to be?
40%.
It's going to be the same thing. So in this case, right? At least I know for a fact that it's going to be consistently the same 40%, right? It's still going to be 1 over 5 times 2. Okay? So in this case, now, what's my depreciation expense for year 2? $72, right? You're going to take 40% of 180, and it's going to give you $72. Okay? So then, what's now my accumulated depreciation for year 2?
190.
192.
192.
192, right? You're going to add them together because now you're just creating an account balance here. So therefore, you're just adding what you have to the pile. So in this case, right, I have 192. So then my book value at the end of year 2 becomes, right,
108.
108. So I have again 300 minus 192 becomes 108. Okay. So then my book value or my depreciation basis for year 3 becomes 108. Okay. So let's keep solving. So 108. 108 times 40%. What is that going to be?
43.20.
Good, $43.20. So then that's gonna bring your depreciation, accumulated depreciation to be
235.20.
235.20. So then your book value at the end of year 3 is going to be
64.80.
64.80. Okay? Which then becomes your book or your depreciation basis for year 4. Okay? So let's keep solving here. So what is 40% of 64.80?
25.92.
Good. Right? Add those two numbers together. My accumulated depreciation is going to be
261.12.
261.12. And then your book value
38.88.
38.88. So as you can see, it's shrinking in value to now, right now we're at 33.88. Okay, so let me see here. Let's insert one. So you got year 5 here. So again, if 38.88 is going to be my beginning of the year's book value for year 5, what is 40% of that?
$15.55.
15.55, bringing my accumulated depreciation to be
276.67.
276.67, which brings your book value to be $23.33. Now, in this case, it's reached its end of its life, right? It's been used for 5 years. Now, this is a cash register. You have 2 options. Now, cash register, right? It's a pretty simple idea, right? At this point, when it reaches end of its life, there's going to be, its buttons are going to be jammed in, or, the springs for the cash register to spit the money out. Something, or maybe even the typing, it can't type a certain letter, or, there's just going to be a lot of things that are going to be wrong at the end of its lifetime. It's worn out, right? Because you used it so much. Now, in this case, a cash register, you have the choice, right? You can keep pushing it until it reaches 0. That's completely okay, because right now, my salvage value is still $23.33. However, again, you'd probably be spending more money to have to fix it or repair it. You're better off just buying a brand new cash register, because at the end of the day, right, it will cost you a lot more to fix things, like fix a spring in there, right? It might cost you $50. This cash register, it's only cost you $300. Why would you spend $50 to fix a spring in it? You know, because that's that. You know, at the end of the day, if you go upgrade or update your cash register, you have a better, better technology. Maybe this time you have like a tablet, like a different POS system, where it's a tablet now where you can tap everything and it's more automated, tech savvy, whatever it is, right? So again, you can upgrade and get just a different cash register, okay? Because you're better off, because everything's going to be a lot more better, cleaner, and not many buttons are broken, okay? So with that being said, you do have the option, right? You can continue to keep depreciating it, or you can scrap it off and just take the loss on $23.33. Now, you can, again, like I've mentioned before, depreciate it one more year to try to get, it the full useful of its life. Right now, it's reached its end, but we know that it can go further, right? We look at the condition of it, and it can be used for one more year. Now, in this case, because salvage value did not fall below book value, you should be okay to continue depreciating it, right? There's no law against, you were supposed to throw it out by 5 years. No, you can keep going and continuing with this life because, again, as a sole proprietor, you have that option, okay? But in this case, right, if it's something that you think that it's you're better off just buying a brand new one and just scrap the $23, then you're going to dispose this asset by either selling it or completely taking it out of a loss on disposal of assets. Okay, so again, right now it's worth $23.33, but in this case, we all know who's gonna buy a cash register from us that's 5 years old and it's been used. Really, nobody would. So in this case, you would most likely scrap it for either, scrap it for metal, or you just recycle it. That's it there. So in this case, right, let's go ahead and do question 2 and number 3 here. Record the depreciation for the first year. Okay. So in this case, assuming that the end of the year is December 31st, okay, how do I journalize my transaction? How do I record my adjustments?
You debit depreciation expense and credit accumulation. Accumulated depreciation.
Correct. I know, it's a tough word to say. So, accumulated depreciation. Okay? So, think of it as appreciate, but this time you're not appreciating, so that's depreciation. Okay? So, there you go. And this time, what was my value, my depreciation expense for year 1?
120.
$120. Okay. So then, how do I, what's my adjustment entry for year 2? Okay.
Same thing. Depreciation expense. Accumulate depreciation.
Correct. So in this case,
$72.
$72 for the second year. Okay. And of course, your description could be adjustment for depreciation, depreciating your assets for the year, anything that's remotely relatable to this. Because in this case, this is an adjustment that you must do as part of your books, okay? Because at the end of the year, when you close out your books and make your adjustments, this is definitely one of the things you have to do, especially when you purchase fixed assets. So we'll talk about again we'll talk about the accounting cycle at the very end. So when we reach chapter actually after chapter 12, we're going to dive right into the fictitious business. So when we do that, that is where it's going to be the where you have to do all these adjustments and things like that. Okay. All right. Question number 4 through 6. Okay. In this case, right, we decided to purchase a computer for $1,988. Okay, which includes all fees and taxes and things like that. Okay. With a salvage value of $200. Okay, its estimated useful life is 5 years, and of course, you put this computer into service as of August 25th. Assume that the adjustment entries are going to be done at the end of the year, December 31st. Okay, so in this case, right, you will, okay, so in this case, what did I buy?
A computer,
Okay, how much did the computer cost me?
1,988.
Okay, so 1988. Okay, what's my salvage value?
200.
Yeah, I must have a salvage value at the end for $200. Its estimated useful life.
5 years.
And when is the date that you placed it into service?
August 25th.
August 25th. So what does that tell us?
Only partial.
It's partial years, right? So in this case, August 25th. When do I actually start depreciating it?
Starting August.
September.
September, because in this case, I only have what? 6 more days in August? Does that count? Is that more than 50% of the month? No, it's less. It's way less than that, right? So in this case, we're just gonna assume, okay, it's fine. We can just depreciate it as of September, okay? Because it's less than 50% of the month. So in this case, let's go ahead and dive right into my depreciation. So what's my depreciation basis going to be for year 1?
1,988.
Correct, right? It's going to be your beginning of the year's book value of 1988. Okay. What is going to be my depreciation rate?
It's still 40%, isn't it?
Yes, so it's
And then
going to
we
be,
go
yeah,
partial after.
yes. Good. So in this case, the rate's going to stay the same, right? Or in this case, whatever you saw for the rate is going to be 1 over the estimated useful life times 2. We don't do the partial years here. You can if you'd like. That's acceptable as well if you want to do the rate, so then you don't have to calculate it again during the depreciation expense. You can just convert the rate in terms of the time that you have for the actual age of the asset, and then just solve the depreciation expense that way. Yes, you can do that. But in this case, it's just way much easier if you just do it right in the depreciation expense. So in this case, right, what's my depreciation expense going to be?
$795.20.
Okay. Now that is for the whole entire year. Is my asset a year old right now?
No,
No.
4 months.
It's only 4 months, right? If we're depreciating starting September, we gotta do September, October, November, December. It's only 4 months old. So this is what we have to figure out here. We cannot depreciate it for the whole year. So in this case, we gotta figure out what 4 months out of 12 equals. In this case, 1/3, right? So you have two choices. You can either do 0.333333, or you could do 4 out of 12, or you could divide the whole thing by 3, because that's going to give you the same thing as 1/3, right? Because this is what this number is 1/3. Okay. So we write 4 out of 12 equals 1/3. Okay. So in this case, I have to take my depreciation expense and figure out how much it's going to be if my asset is only 4 months old. So in this case, I'm going to take my 795.20, and I'm just going to divide that whole entire thing by 3, or what I can do here is multiply by 4 divided by 12. Okay? If this is kind of difficult for you to understand, there's the best ways you could do it this way too. You can divide the whole thing by 12, so then you know how much it's going to cost you per month, and then multiply it by the number of months that the asset is. So you can divide the whole thing by 12 and then multiply by 4. That way you can kind of figure it out that way too, that okay, if it costs me this much to depreciate per month, then I need to figure out how much it is for 4 months. So I just multiply it by 4. That's also another way that you can do it that way too. But in this case, whichever method that you find it easier, as long as you can understand that it is not for a full year. It's only for 4 months or 1/3 of a year. Okay, so in this case, that should give you 265.07, right? 765.20 divided by 3, right? Should give you 265.07. Right, your accumulated depreciation is going to be the same for the first year just because there's no previous year. So then how much is my book value going to be at the end of year 1?
$1722.93.
1722.93. All right, which then becomes my depreciation basis for year 2. Okay. So in this case, now, since I depreciated my asset as of September, right? That means starting my second year, it's going to be for a full year, because if you're holding onto your asset, now you're depreciating it as of January 1st all the way to December 31st. Now we're going to be solving for the whole year. So in this case, what's my rate going to be?
40%.
It's going to be the same number consistently for all the rest of it, right? It's going to be 40%, okay? So what is 40% of 1722.93?
689.17.
689.17, okay? So then, what's my accumulated depreciation?
954.24.
954.24, bringing my book value to be
1033.76.
1033.76. All right, which then becomes my depreciation basis for year 3. Okay. So what's my depreciation expense going to be for year 3?
$413.50.
413.50. Okay. Plus my previous is going to give me my cumulative depreciation to be
1367.74.
okay. So then that will drop my book value to be, oops. What's my book value at the end of year 3?
620.26.
6/20/26. So here, if you look at this trend here, right, my book value is dropping pretty fast. So therefore, for now it's year 4, I'm starting at $620.26. 40% of that is going to give you
248.10.
248.10. Okay. What's my accumulated depreciation?
$1615.84.
1615.84. And then last but not least, my book value is going to be
372.16.
372.16. So let's keep depreciating it because we still have enough, right? It's right now it's only 372.16. My book value, right, or my salvage value is $200. So in this case, I can still keep depreciating it. Okay, so let's go ahead and depreciate it one more time, right? It's still on its 5th year. Now, is it really 5 years old right now?
No.
No, it's only 4 and 4 months old. 4 years and 4 months old. So in this case, yes, we should be continuing to depreciate for the 5th year, or according to the accounting period. But we know that our asset is 4 and 4 months old. Okay? So in this case, what is going to be my depreciation expense for year 5?
148.86.
148.86. Okay. Which makes my accumulated depreciation amount to be,
1764.70.
all right? Which then brings my book value to
223.30.
223.30. So in this case, right, can I continue depreciating?
Kinda.
Yes.
Yes, because right now, how old is my asset?
5 years.
Is it really 5 years?
Oh,
No. 4.48.
4 and 4 months.
4. 4 and 4.
Right? It's only 4 and 4 months old. So in this case, I still have 8 months that I can still depreciate it for. And I can still depreciate because right now I haven't reached salvage value yet. So in this case, right, I can go for another year. Okay? But in this case, right, let's go ahead and plug that number in. So what is 40% of $223.30?
Teacher,
Yes.
before this step, salvage useful lot. What is this? 200.
That's when at
Salvage value 200.
okay.
Can I do without return to the 40% and put the depreciation expense for the number 6 year? 6 year is 23.30 direct for
Well,
the six. No, for the 6 year.
I know I'm on the wrong one. Let me go ahead and undo that. Yes, you can. And I was gonna say, usually when you go forward and you solve that, it falls below. Yes, you can do that. I was gonna teach that afterwards. But yes. But let's just go ahead and go forward first. So what is 40% of 123.30?
89.32.
89.32, which gives you a accumulated depreciation of
1854.02.
1854.02, which brings your book value to
133.98.
133.98. In this case, my book value fell below salvage value. So in this case, right, what I have to do is I have to scrap this and work backwards. Okay? Now, if you can see it ahead of time, then you can automatically know, well, if my salvage value needs to be 200, right? What's the difference between 200 and my previous one? Yes, you can do that. But I want you also to make sure that if you don't see that and you can't figure it out in your head what that is, then go ahead and use the equation to work backwards. So in this case, right, I know I need to be at 200. Okay? And in this case, I need to work backwards, right? My formula to solve for my accumulated depreciation is going to be my asset cost minus salvage value. Or in this case, my asset cost minus book value. So in this case, right, to solve for this, we know it's going to be my asset cost of the 1988, and it's going to be subtracting out my book value of 200, which gives me 1788 even. Okay? Now I need to work one more step backwards because now I need to solve for my depreciation expense. Well, I know this much that my accumulated depreciation formula is going to be previous years plus current years. So if I plug my numbers in, I can easily solve for the remaining amount. So in this case, right, I know for a fact it's going to be my accumulated depreciation minus my previous year's depreciation, accumulated depreciation, which will give me $23.30 for depreciation expense. Okay? This one, you cannot apply the 80% rule here or 8-month rule because it will not work either. Okay? You're going to fall again below salvage value too. But it doesn't hurt to try. So if I were to do that, right, then this number, let's see. If I were to modify this and say this is for only 8 months times 8 divided by 12, that's going to give me 59.55. So at the end of the day, it's still going to be way too much. It's still going to bring you down to salvage value of 163. So in this case, you're still going to have to work backwards to solve for this. Okay, so let me just go ahead and revert back to what it was previously. okay, which was $89. Okay, so in this case, it is going to still be drastic. Now again, what Acct did was he looked at this previous book value and he knew that the salvage value had to be 200. That's also a way that you can figure that number out and you can work forward. Okay? But like I mentioned, if the number is not that obvious, then work backwards. You're safer to work backwards than to figure it out if you can't figure that big number out. Okay? So in this case, at the very end, it reached the end of its life, right? You can call it at the end of 8 months, right? During the accounting period, right? That you depreciated for $23.30 to bring you to your book value to equal salvage value. Okay? All right. So, last thing here for question 5 and question 6 is to go ahead and journalize your entry for the depreciation. Okay, so the first one is for the first year. So, assuming that you're depreciating at the end of December, okay, 31st. So, in this case, what is my journal going to look like?
With a depreciation expense debit and a credit on accumulated depreciation.
Good. Depreciation expense and accumulated depreciation. Okay. And for what amount?
$265.07.
$265.07 for the first year. Okay. And then what's my journal going to be for the second year?
Same thing, depreciation expense and accumulated depreciation.
Good. And it's going to be for the second year, which is going to be for the full $689.17. Okay. Any questions in regards to double declining?
No.
Nope.
All right. Okay. Well, if there are no extra questions, okay.